Hey everyone, in this video we're going to be discussing trading stock. So what is trading stock? So if you carry on a business and you're not selling digital products, you're selling physical products, trading stock is those physical items which you own or carry for the purpose of selling or exchanging in the ordinary course of business. So for example, it could be a property developer. Your trading stock could be apartments under construction. Or you could be a car dealer and your trading stock would be the vehicles. Now, in the hands of someone else who's not carrying on a business, this doesn't necessarily, it might be on capital account, might not be on revenue account. In those two examples I gave before, most likely both of those would have been on capital account, properties and cars. But another example of a business where it would be revenue account regardless is potentially, just a mechanic whose trading stock might be the oils out front, might be the spare parts potentially as well. But yeah, you get the idea. So it's really just anything that you hold on hand in order to carry on a business for the purpose of selling in the ordinary course of business. Now this definition here, ordinary course of business, is also an important concept because as we get to something later on in the chapter, you can actually sell something out of the ordinary course of business. It doesn't constitute trading stock, but there will be tax implications for that, which we'll cover later on. But ordinary course of the business. So let's say you are a Apple store. What you do in the ordinary course of business is sell iPhones. You sell accessories. You sell online vouchers for the Apple store and things like that, right? So outside the ordinary course of business would be the sale of the store itself, right? Or it could be, I don't know, whatever it is. So it's something that's still a transaction, but it's not your ordinary business, that what you do, right? So you need to figure out what's the ordinary business that this particular business carries on, and anything that it does in that ordinary course would constitute, trading stock. Anything outside of it might not constitute trading stock. So here are some specific examples of what trading stock includes. So it's partly completed work that, if completed, would be trading stock. So this is called work in progress. It also includes materials that the person holds for use in producing trading stock, for example, raw materials. And also property on which the person has incurred expenditure when the property would, if they had it, be trading stock. And finally, certain property leased under a hire purchase agreement while carrying on a leasing business. So these are all quite specific examples. So it could be, Tesla, for example, manufacturing cars, half-produced cars, which have, mostly assembled but not completed, would still count as work in progress, as would the completed cars on hand as well. But also any materials that they've got hanging around, like the iron ore, the lithium for the batteries, that would all be raw materials. That would also constitute trading stock for Tesla. And also property on which the person's incurred expenditure when the property would, if they had it, be trading stock. Now, for Tesla, this probably isn't as relevant, but if you're a property developer and you've got a building that's half developed and it's property and they've incurred expenditure on getting to that state, even though it's not a completed apartment, it would still be trading stock in that case. And also hire purchase agreement if you're carrying on a leasing business. So if you are Hertz Cars, for example, or Caterpillar, which leases out equipment, any equipment that you own that you've leased out under a hire purchase agreement would still count as trading stock, provided that you get it back. And it's not like a finance lease at the end of the day, so it's an operating lease or a hire purchase agreement. And there's also a number of exclusions from trading stock, so these aren't classified as trading stock. Number one, land, unless of course you're in a very specific situation where you deal in the sale of land, like a land dealer, but otherwise land is not trading stock. Depreciable property is not trading stock, neither is financial arrangements. Livestock is not, because that's dealt with a different section where we talk about farming, etc. So, but livestock is trading stock under those provisions, but if it's not used in dealing operations, for example, if you're just a farm and you own a farm, that's not trading stock. But if you do deal with, like if you regularly sell and if you buy and sell cattle on a regular basis, that's your business, then it would be trading stock. Any consumable aids used in producing trading stock, like if you're at Tesla, for example, and all the weight belts that help your staff not get back injuries, oil and things like that. That's all the consumable aids. That will also be trading stock. Any spare parts not held for sale or exchange. So, Tesla or a mechanic, they've got, spare air filters lying around or spare tires. That would be trading stock as well, as would emissions trading units, as well as some foreign investment fund investments. So, here's a couple of examples of quite specific things. Some of them we've mentioned, some of them we haven't, and not all of them constitute trading stock, but this helps you kind of understand in these specific situations when it would be trading stock and when it wouldn't be trading stock. So, computer software, if it's developed for sale, then yes, it would be trading stock, noting that development costs are expensed. But if it's not developed for sale, i.e. they've just purchased it off the shelf software, then no, it would probably be capitalized as intangible assets. But if you are a software company developing software with the purpose of developing it, then yes, that would be trading stock. Next, containers, labels, and packaging materials. If they are integrated for sale as part of the product, then yes. For example, if you have polystyrene foam used by a manufacturer to package products for shipping to retailers, yes, that would be trading stock. But if it's not part of the product, for example, you have bubble wrap lying around to secure a product at the time of the sale to protect it from damage, but it doesn't actually go along with the sale. Like maybe you just ship it in between your warehouse to your retailer, but then you take off the bubble wrap and you pull it away from the product and sell it without the bubble wrap, that wouldn't be trading stock. What about crops and plants? So if crops are severed, i.e. grapes that are picked from the vine, then yes, it would be trading stock. But if it's the actual crop itself, like you're just having grapes on the vines, that would not be crops. That would not be trading stock, sorry. And plants, if it's in the pots, yes, but if it's in the ground, no. So this is basically the distinction between what is, a farming asset versus what is something that you can actually sell, is basically the distinction. So if it's in the ground, it's a farming asset. So it's a plant in the ground. You can't really sell that unless you've severed it. If it's in a pot, you can sell a plant in a pot, right? So therefore, it will be trading stocks. It's just logic. But this relates to case T1. What about land? We mentioned this one above. So generally, it's not trading stock unless the land was acquired for resale and the business activity involving dealing the land has commenced. So basically, you're a land dealer and you've acquired the land for resale. In those situations, yes, it's trading stock. In all other accounts, no, it's on capital account. And it's actually specifically excluded in every situation unless you're a land dealer per this. And that was determined per Murray Darnell Limited versus Tax Review Authority. All right, what else? So consignment stock. So what is consignment stock? First of all, it's basically stock that's been delivered by a manufacturer to a customer for display or marketing purposes. But it's not owned by the seller. It's owned by the manufacturer until the stock is actually on-sold by the customer. Until that point, it's owned by the manufacturer. So as soon as it's sold by the reseller to the customer, then the ownership is transferred and then the manufacturer gets the sale and transfers ownership at the same time that the on-seller then sells to the customer. So this is only if the stock is consignment stock. Not all resellers operate on consignment stock. It's only if the manufacturer allows this. So you need to first of all check that it actually is on consignment. So basically, it's not trading stock if it's not owned by the reseller, right? Because how could it be trading stock if they don't actually own it? So if the stock has not been unsold and it's still owned by the trader must include the consignment stock in the closing balance of their trading stock. Next is returnable containers. So generally items that would be returned to the taxpayer, like wooden pallets, gas cylinders, etc. So it's not trading stock, as these items are usually treated as plant, i.e. depreciable assets. This is in contrast to packaging items such as containers, jars, tins, and cartons are trading stock, where they kind of pass to the purchaser, if you remember from over here. So if it's if you're selling peanut butter, the jar which comes with the peanut butter is transferred to the customer at sale, therefore that's trading stock. But if it's not, if you remember from over here, if it's not transferred to the customer at the time of sale, for example, just bubble wrap around the product, which doesn't transfer, it's just for transferring between warehouse, and that wouldn't be trading stock. Next is shares. So this is another interesting one, like land, where generally it's considered on capital account, but if you're in the business of trading that specific asset, then it actually is on revenue account. So if you're in the business of trading shares, and this is quite a difficult distinction to make, like there's a number of tests that you can look at. Like you need to, show that you actually operating as a business, right? So that maybe that's, do you have a professional experience in it? Have you got a company or other entity set up? Do you have an office? What's the volume and what's the dollar value of transactions? How many transactions are you doing? What's the speed of transactions? So these are all indicators that you're operating as a business. But if you can't satisfy those things, then it's held on capital account because you're not in the business of trading shares. And that's per case N12. And then finally, spare parts and consumables. I think we touched on that above. If the spare parts are held for sale or exchange, then yes, they are trading stock. But if they are held to be used as part of the production process, then no. So if you are a mechanic and you're selling, for example, spare tires, spare air filters, because when a customer comes in, you can upsell them to those products and say, I'll install that for you, then yes, that would be trading stock. But if you're a manufacturer and you're just putting that aside because you just need extra ones to produce the vehicle, then no, it wouldn't be trading stock. Okay, so let's talk about the impact of trading stock upon taxable income. So the first principle we need to discuss is the fact that per tax treatment, how we account for trading stock is different to accounting. So under accounting, if you remember from financial reporting, you get a choice between either the period or perpetual methodology, where under tax you only get this, periodic. So how the tax accounting or tax treatment of trading stock works is, there's 3 steps. Number 1, a taxpayer who uses the periodic inventory system is allowed a deduction for purchases made in the period. So any purchases that you make throughout the year, you get a deduction for. And under DB 49, taxpayer may deduct opening stock and has income of the amount of their closing stock. So basically there's 2 steps. Number 1, you get a deduction for any purchases you made during the year. And number 2, you make an adjustment for either it depends on whether the closing stock is greater than the opening stock or whether the opening stock is greater than the closing stock. One of them is going to result in a revenue adjustment. One of them is going to result in an extra deduction. So basically add up the 2. And then this is the final concluding step, which where the opening balance exceeds the closing stock, a taxpayer will have a deduction for the income year and vice versa. So you add up all the 3. You add up your purchases plus your adjustment for closing versus opening, and that gets you to your either assessable income or deduction for tax purposes. So here's an example here. It's good to look at an example how this works for trading stock because it can be a little bit confusing. And it also tells us the legislative references, which is handy. So in this situation, we've got a company which operates the distribution of coffee beans. And during the year, they've sold coffee beans of $600,000. And they figured at the end of the year, the value of their closing stock is $70,000. And at the beginning of the year, the value of their opening stock was $40,000. And throughout the year, they've also purchased $200,000 worth of stock. So how it works is, if you include sales revenue as a first step, and we're just going to calculate taxable income, and we're going to assume that they have no other expenses, just to keep things simple. The first thing is, what's the adjustment between the closing stock and the opening stock? Well, in this case, the closing stock is $70,000 and the opening stock was $40,000. So what it says under here, under DB 49, a taxpayer may deduct the opening stock amount and has income of the amount of the closing stock. So the closing stock is income, so you put that $70,000 over here, and your closing stock is negative. Your opening stock is negative, so it's negative $40,000. So basically, if your closing stock is greater than your opening stock, you get assessable income, or if it's the other way around, you get a deduction. So if their closing stock was, say, $10,000, what we would do is we'd do $600,000 minus $10,000 plus $40,000, so you'd actually get $570,000 for your gross profit over here. But because the closing stock was higher than the opening stock, we've got gross profit at $630K. But we also get a deduction for any purchases of trading stock throughout the year of $200,000. This would bring our taxable income of $430,000. And remember to include your legislative references, because in the tax module, it's always super important to include that. Not so important for the other modules like Fin, Math, etc., but this one it is important to include. Now you might be wondering, why do we do this? Well, the purchases is fairly self-explanatory. You pay the money, you get the stock, therefore you get a deduction for it. But what about this, the closing stock and the opening adjustment? Well, it's basically meant to reflect the fact that if your closing stock has changed from your opening stock, indicates that you've used some of that stock throughout the year. And using some of that stock reflects an expense, doesn't it? That you need to take into account. And so that would be if your closing stock's lower, you would get a deduction, right? That makes sense. Because you've used it in your sales, therefore cost of goods sold, you get a deduction for it. Vice versa, if your closing stock has increased on your opening stock, it must mean that somewhere along the lines you've brought in extra stock that hasn't been purchased for whatever reason. Maybe you found stock, maybe the value of that stock has increased. For whatever reason, your stock has increased, and therefore you need to record that as assessable income. But in the next year, if the value of that declines, for whatever reason, you'll get a deduction for it. So hopefully that makes sense as to why we take this approach. So what about trading stock that you've purchased but haven't delivered? And this is a common trick question that you'll get in exams, and you need to look at the specific date that the stock has actually arrived, because maybe it's arrived in the next financial year, but they've paid for it in the current financial year. So the question will kind of infer that you need to figure out whether to include it in your purchases of trading stock or not. So the rule, and this one's important, is that if a taxpayer has purchased trading stock that has not been delivered by balance date, the taxpayer may still be eligible for the deduction of stock, provided it would have been treated as trading stock if it had been delivered. So if it has not been delivered, the taxpayer may be eligible for deduction. So you can still claim it even if it hasn't arrived. So there's the trick to look out for. So an example of this is a company with a 30 March year end. So if they've paid for it on 30 March, which is the year end, but they haven't actually received the stock, it's in the next financial year, that you'd still get the deduction in the current financial year. And they might do it vice versa, where you're in the next financial year and they say you got stock delivered on this date worth $70,000, but they paid for it last year. You got to work out that you don't actually include that, because that would have been included in the previous financial year. Something to look out for. Okay, so, and this is just talking about how that opening stock and closing stock obviously impacts your assessable income and your taxable income, even if you haven't spent money on it during the year. Maybe you're obviously you've used the stock and therefore the value's gone down, or the value of that stock has changed. And this next section is just talking about how you actually get a choice between how you value your stock. And maybe there's an adjustment just because of how it's been valued. So the opening stock from one year to the next is pretty straightforward. It's just whatever the closing stock was from the previous year. So for example, if our closing stock this year was $70,000, next year when we do the calculation, it's just going to be negative $70,000 down here. So the closing stock for tax purposes, closing stock is valued by applying one of the four alternative standard valuation methods outlined in EB4, either cost, discounted selling price, or replacement valuation methods. Now, this also gives the taxpayer a little bit of leeway in that they can actually choose what methodology they're going to use for valuing their stock. Therefore, what they could do for tax planning or tax minimization, which, if you remember from the ethics chapter, is legal because it's actually one of the options they're allowed to do. So it's well within their right to choose the method which reduces their tax payable. That's perfectly ethical and legal. So, and you're going to get some exam questions on this, particularly in like the quizzes, for example, where it'll say something along the lines of the taxpayer wants to minimize their taxable income. Which of the following valuation methods should they choose? And basically, you need to figure out, well, in order to minimize our taxable income, we want to maximize our deduction here. So in order to do that, we want to minimize the value of our closing stock, because as you can see, if you add the two together, if the closing stock is higher, you're going to have a higher assessable income. So we want to reduce the value of our closing stock to minimize our taxable income for that particular year. That's a very common question for quizzes, but also comes up in final exams as well. So the four methods, we'll talk about them one by one, and then depending on the question, in the quizzes they'll just tell you what the value is for each of them, but you might have to calculate them as well and figure out which one of them is the lowest cost, which will help lowest valuation, which will enable us to minimize our taxable income. So the first method, remember the four methods are cost, discounted selling price, or replacement price valuation. So the first method that we're going to talk about is cost. So this is basically what is the cost incurred in the ordinary course of business to bring that trading stock to its present location and condition, including acquisition costs and cost of production. So it's basically all the costs that you've paid, whether that's how much you paid to the manufacturer, for the stock, any shipping costs, was there any, fees like to the port authorities when you shipped it over here, was there any particular repair cost to the inventory to bring it up to the current standard, anything like that would be included in the cost. So there's another consideration here, is that if you choose the cost method, you must allocate costs under IFRS standards. That means the value of the stock shouldn't be materially different to what you valued it per the accounting standards in your own financial accounts. Now, there's one of two cost flow methods. So if you remember from financial reporting, there's a couple of ways you can measure it. For example, first in, first out. And this is particularly important when you're purchasing inventory that the price fluctuates over time, right? Maybe you're buying lobster, right? And the price of lobster varies each week based on demand and supply in that market. So how do you actually value it? If you're going to sell, $1 million inventory in one bulk, but you've bought that inventory over a period of a year at varying different prices, how do you figure out what the price is for your stock that you've sold in that 600K batch or $1 million batch, whatever it was? So basically, there's a couple of options. Number one, there's first in, first out. That's basically let's say you sell $1 million worth of stock. So you figure out how much stock you used to calculate that, and you look at your first amount of stock. So maybe you sold 60,000 units. So you'd look at each of the batches that you bought. So let's say on day 1 you bought 10,000, day 2 you bought 30,000, day 3 you bought 20,000 or 15,000, and then day 4 you bought 15,000 again. So you kind of add up the first batch, then the second batch, then the third batch, up until you hit that 60,000 mark, and you might have to prorata the last batch just to get it up to the exact amount that you need, which corresponds to your sale. And you do that with your first batches that you purchase. So let's say you bought them a year ago, 9 months ago, you'd use the batch from then rather than the batch you just bought last week. Then the second option you can choose from is the weighted average cost method, which is accepted when the actual cost cannot be ascertained, which can be tricky if you're dealing with multiple different transactions over the year. You can just say, well, the average cost that we've paid based on all of the products we've bought. So let's say we sold $60,000. We bought them at different prices. We work out what the average price is, and we just times that 60,000 by the average price. And that will be our cost of inventory. Now, if you're a manufacturer or producer of trading stock, like you're not a reseller, you actually produce the stuff, you can also allocate costs using either of the below. Either the budgeted cost method or the standard cost method. So how much you're budgeting for it to cost, how much it costs under the standard method. We don't go into a lot of detail in this method. Generally, we deal with these two over here for cost. And the reference you need for cost method of valuing trading stock is over here. It's EB41. Remember, whenever you write an exam question, less important for the quizzes, but definitely important for your final exam, you need to include section references for the tax module. So the next method of valuation is the discounted selling price. So this can only be used for tax purposes if it's also used in your taxpayer's FinStats. So for trading stocks, there's a lot of correlation between financial reporting and tax, which is quite unusual. Generally, there's no distinct correlation between the two. And if you report something for financial, it doesn't really matter for tax purposes because you have to follow whatever the legislation is. But for trading stock, it is weirdly specifically linked to financial reporting as well. So if you use it in your FinStats for accounting, you need to you can only choose this method for tax. You can choose another method if you want, but you can only choose this particular one if the taxpayer also used it in their FinStats. So the calculation depends on whether you are a retailer or not. And there's 3 different calculations that we need to be across. So number 1 is if you're not a retailer. So for example, I don't know, you might be just a small business operating out of it. Maybe you're a manufacturer, and so forth. Or you could be a retailer. So think about your supermarkets, your Costco's, your Kmart's and Targets. If you're purchasing from a manufacturer and selling it, most likely you're a retailer. And there's 2 distinctions here. Either you're below 1 million or you're above 1 million. I might just highlight that so it's a little bit more obvious and stands out. Now, depending on which category you're in, is a different formula. So, it's not too difficult to you just follow the formula. So if you're not a retailer, it's just market selling price less gross profit equals your discounted selling price of that stock. If you are a retailer with turnover of less than $1 million, it's the total of retail selling prices. So notice the difference between market selling value versus retail selling prices. It's your RRP basically, minus your average gross profit margin across all products. And the only difference between this is normal versus average. So similar, but slightly different, right? Equals your discounted selling price. And then if you've got a turnover of greater than $1 million, it's a total of retail selling prices minus your normal gross profit margin, applying NZIS 2 over the department or category of goods. So you actually have to split those by department as opposed to all products. That's probably the key difference here. And then next valuation method is replacement price. So again, you can only use this for tax purposes if this is used in the taxpayer's FinStats. So for this method, the replacement price of trading stock is either 1, the market value of the stock on the last day of the income year, or 2, if there is no market value, the last price, inclusive of goods and services tax, that was paid during the income year to acquire equivalent trading stock. So it's basically what the stock is valued at today's date. But again, you can only use this if you use this method in your financial statements for accounting purposes. And then finally is the market selling value. So number 1, this is basically, it can only be used if lower than the cost of the stock itself. You can't do this to increase your trading stock valuation. So taxpayers must be able to substantiate market selling value. If they cannot do so, one of the other 3 valuations methods must be used above. So there must be some sort of active market so you can actually point to it and say, yes, that is proof that the market selling value of our stock is this. So if you have a fairly unique product, you probably couldn't use this method. The IR considers that sales in the ordinary course of business includes clearance sales, but not sales that are not at arm's length or not on the open market, such as discount sales to employees. So what this means is if the market value of your goods is $100 in the ordinary course of business, that would be your market value. But if your business regularly has these clearance sales where they offer 10, 20, 30% off your stock and it's available to the public, you could use that as your market value. And maybe that's, if that's lower than the cost of stock, you can use that and that will enable you to reduce your assessable income for that year because if it's lower than the cost of stock, it's going to result in a more favorable outcome. But the key is it must be available to the public, right? Because that is at arm's length. If it's not at arm's length, then basically a fair transaction between 2 parties who don't know each other is basically what that means. If it's not on the open market, for example, if you offer discounts to employees, which is not available to the public, that's not arm's length, right? And you could fix the system. You could get around it by saying, oh, we offer our employees 100% off, therefore the value of our stock is 0. Obviously, it doesn't make sense because that's not what you're selling to the public. Therefore, that's not the market value of your goods. So yeah, this is a good option to potentially consider. And there's also no obligation that the company has to do this as the main method in their financial statements. So this is a good method to kind of choose, but it could also go against you depending on what happens in the market value next year of your goods. So the market value is the anticipated proceeds less the estimated cost of completion and the expected cost of selling the stock, whether that's transport, insurance, sale commissions, or discounts, if used in the FinStats in calculating net realizable value. So there's the formula there. It's anticipated sale proceeds minus estimated cost of completing plus expected cost of selling equals the market selling value. Now the other consideration is you can't just use this for obsolete trading stock because obviously if obsolete trading stock is being sold below its original retail price, but for more than cost, it must be valued at cost. And this would basically be another way of getting around the system because if your obsolete trading stock is worth 0, you could just say, it's worth 0 and therefore have reduced all of your taxable income. Okay, now let's talk about disposal of trading stock. And this is where this concept of in the ordinary course of business starts to become more important because we will have this situation in a moment where it's disposed of other than in the ordinary course of business. I'll just highlight that as well. So we'll come to that in a moment. So the simplest and easiest one, which applies to most transactions in a business, is trading stock sold in the ordinary course of business. So it's fairly straightforward. The proceeds are brought to account as ordinary income under CV1. So it's just your business income, like your revenue, right? Fairly straightforward. What about where your stock is lost or destroyed? What do you do there? So basically any stock that's lost, whether that's through theft or being destroyed, you don't include that in the closing stock value, because the reason is you don't have the corresponding income. Otherwise, you're going to have a... if you don't... as I said, if it's not in your income, because you're not selling it if it's gone, why should you have to pay assessable income on it if it's not there, right? So it just logically it makes sense for it not to be in the closing stock. So in other words, the closing stock for that particular stolen, lost, or destroyed item will be nil. But that being said, the taxpayer should be reimbursed for it somehow, right? So the taxpayer will get a deduction for it, and it's not in any new category. What it actually does is, it's actually, because it's not included in closing stock, but it will be included in the opening balance, right? You will basically, as the closing balance will be lower than the opening balance, you'll effectively get a deduction, right? Because if we go back to this diagram over here, if our closing stock, let's just focus on this single item. So let's say we paid $100 for it. It will be in our opening stock from last year as a negative $100. Our closing stock will be zero, and there'll be no sales for it. So therefore, we will get a deduction for negative 100. We'll get a deduction for $100. If we didn't buy it last year, if we bought it this year, it wouldn't be in closing stock, but it would be down here in purchases. So either way, closing stock's going to be zero, opening stock's going to be zero, purchase going to be $100. So in either situation, we're going to get a $100 deduction, no income, no matter what. So the taxpayer will be reimbursed via that deduction. So this is what this is just saying down here. Is it's just saying that if you bought during the year, it'd be through DA1 as a purchase, or if it was in prior year, it'll be in the opening value. Either way, you're getting a deduction for it. Now, what happens if you get insurance payment for the stock that you've lost or found? How does that work? Well, if that's the case, you can still claim a deduction for it, but that will be income. Like any insurance payments that you receive will be income. So you're basically getting $100 income, $100 deduction. It's going to net out. So basically, you're not going to be in any negative position, but you will be receiving the cash for the insurance for it. So you'll be in the same position you were before, theoretically. What about in a situation where you don't receive inadequate consideration? So for example, you're selling something below market rate. Is that a discount? Is it because it's obsolete, you need to get rid of it? Is it because it was traded to a related party at a favorable rate? So what happens if it's sold for inadequate consideration or no consideration is that it's deemed to be sold for its market value. So that will prevent a situation where two related parties trying to avoid tax, one will sell it at below market, and they're thinking, I'm going to sell it, I'm going to have a low revenue, going to pay low tax, but I can always get the deduction because my opening balance is at, say, cost, whatever. Well, that would be one way of, getting around the tax scheme, right? But obviously that's unethical and not in the intention of the law. But this rule here actually prevents that from happening at all, because it actually deems a purchase price to be at market value. So the amount that you're putting in your tax return for your sales is actually going to have to be higher than what you actually received in cash. So something the commissioner can do if they step in, and you're meant to technically do that yourself as well. But okay, so we're disposed of other than in the ordinary course of business. Okay, so this is the concept that I wanted to talk to you about earlier, because the definition of trading stock is, stock held for the purpose of sale in the ordinary course of business. What about if there's an event which is outside the ordinary course of business? So what are some examples of outside of the ordinary course of business? So it could be the sale of the business itself. I mean, you're not running a business for the purpose of selling a business. Selling a business is a one-off event which could not be expected. It's not really part of what the business mission is. But by doing that, you can actually dispose of your trading stock, right? Or it could be the passing of a property. So you could be selling it. It could be an exchange, gift, distribution after the death of a person. It could be the change of use of a trading stock item. So for example, you are changing your business purpose. So you're no longer a property developer. You're now holding the property on revenue account because you're no longer carrying on that business. The trading stock would then no longer be a trading stock item, so it would be a deemed disposal in that case. That will be outside the ordinary course of the business. So those are the common situations where that might occur. So it's just like a one-off or a non-recurring event, unexpected, not in line with how you normally operate your business. Usually just the sale of the business or disposal of the business, or change from away from a business to being on a revenue account. So what happens in a disposal outside the ordinary course of business? So per section CB2, the taxpayer is required to include that amount that was received for trading stock in their assessable income. So if you sell your business, get rid of the stock, you include that disposal of trading stock in your income. Same as, if you change from carrying on a business to holding an item on revenue account, you would also dispose of that. You'd have to include that in your income. But the person who acquires that trading stock is also deemed to purchase the stock for the dollar value it was disposed of. Okay, hopefully that made sense. Okay, what about private use of trading stock? And this might be relevant for a situation where you've got like a small business, for example, and let's say they run a small supermarket and they sell bread and things like that, and then any given day the owner uses bread, makes himself a lunch, saves himself from having to buy it from someone else at a higher price, at market value. He's just paying zero consideration for it, and he's probably getting it at bulk, discounted prices. So if a company shareholder uses trading stock for their own private purposes, this is treated as the sale of the stock at market value. This also applies to a sole trader or partner in a partnership who withdraws trading stock for their own personal use. And temporary use of a trading stock by a business owner, for example, the private use of dealerships' cars, may be subject to FBT as well. But usually it's one or the other. It's only FBT. If FBT applies, then you don't need to do this disposal. Okay, so here are some other situations where there's change of ownership. So apportionment on sale of business assets that include trading stock, and this is an example of an event that occurs out of the ordinary, out of the ordinary course of your business. So if trading stock is sold with other assets in the business, the sale price of the business must be apportioned between trading stock and other assets, so that the price of the trading stock is reflected in its market value. If this is not done, the commissioner may apportion the sale prices. The commissioner has the ability to reapportion the sale price even if part of the price is apportioned to the sale document, should that apportion not reflect the market value. So basically, as we mentioned above, when there's a disposal outside the ordinary course of business, you need to include that disposal in your ordinary income. So if you're going to sell your business, let's say you run a vet clinic or a medical hospital, or a dental clinic, you sell the hospital. Because that's a capital event, you generally won't pay tax on it, but you do need to figure out what the value of the stock is and include the value of that stock in your assessable income. So you get taxed on a portion of that, and that so the taxpayer would portion it. But if that proportion isn't reflective of market value of all the assets, the commission might step in and adjust it for you. Also, transfer of trading stock within a group. So if you have two companies within a wholly owned group, and that's something else that we'll talk about a little bit later, it can be valued at the cost of the trading stock to the original purchaser. If either of the companies concerned should then exit the group, the company then acquires the stock will have deemed to have both disposed of and reacquired the trading stock at market value at the time the company exits the group. What about change in use of trading stocks? I gave the example before about a developer who, is no longer carrying on a business, right? So it's no longer on revenue account, it would now be on capital account. So if that happens, as we mentioned above, in events outside the ordinary course of business, the taxpayer would just have to include the amount received for the trading stock in their assessable income for that year. Trading stock concessions. So there's two concessions for trading stock. Number one is low turnover traders, and the other one is low value trading stock. So the first one, low turnover traders, this is basically a trader with an annual turnover of less than $3 million. And they may value their trading stock under different rules to other traders. And whichever method is used, it must be applied consistently. So they have a few other options to actually value their stock, but only if the turnover is less than $3 million per year. Now, there's also low value trading stock, and this is where the trader's turnover is even smaller. That's where it's less than $1.3 million US, and the value of the trading stock must also be lower than $10,000. Now, where this person gets an even better concession, right? The smaller the business, the better concession usually. So this low value trading stock has the best concession of all, which is basically they don't need to worry about the closing balance versus opening balance adjustment. Basically, the closing stock can always be valued at opening value for tax purposes. So what that means is this adjustment here between closing stock, opening stock, the net balance is always going to be zero here for that small trader. So that basically the only things they need to worry about is sales revenue less any purchases for the year. So it's basically just a way of allowing that taxpayer to be assessed on a cash basis, because all it is their revenue less what they've actually paid during the year. So pretty good concession. But then again, in any one given year, you might be a large taxpayer where your closing balance is less than your opening stock, and then you would actually get an even better or lower taxable income. But then in the year after that, it might go back to higher, and you might pay more in the year after. So in the long term, it's probably better to have this concession down here as a low value trading stock. Okay, so that's the end of the trading stock chapter. Just as a very quick recap, it's basically what trading stock is. It's basically any property that a person owns who's carrying on a business, and these are quite specifically defined. And you also really need to consider the facts for a number of different situations, because, for example, computer software, depending on what the case facts are, could be either trading stock or not trading stock. You really got to consider for these items. So if you see these words in an exam question, just look out for them, like computer software, consignment stock, and it's to do with trading stock. Just remember these situations, depending on the facts of the case, could be either trading stock or not, and obviously that's going to impact, the taxable income of that particular business. And also we learned about how do you actually calculate trading stock and the relevant legislation. Well, it's basically you take your sales revenue, you adjust for the difference between closing stock and opening stock, depending on which way it goes. And then you also adjust for any purchase of trading stock during the year. And also there's some, the taxpayer has some choices in terms of actually how to value closing stock year on year. I'm not sure if I mentioned this actually. Did I say this? The valuation method can only be changed from one year to the next if required by IFRS. So basically, once you make your initial choice, whether that's market selling price or cost, you need to stick with that cost unless if it's required by IFRS to make the FinStats more reliable and relevant. Unless it's market selling method, then that doesn't apply. And then, so these are the different methods that the taxpayer can use. There's 4 ones there. There's cost, discounted, replacement, market selling. And we also talked about different situations where, if it's outside the ordinary course of business, you actually, you have to actually record that in your income, or if you, lose or destroy your stock, you actually get a deduction for it, and so forth. And also we talked about the concession for low value and low turnover traders. So that's the end of the video. Hopefully you found that useful. I'll see you in the next video.